Hi everyone, this is Steve Elwell, Level's Chief Investment Officer. We thought we'd shoot a quick little video just to answer some common questions that we're hearing from everyone about all this market volatility. What's Level doing about it? What do we think about it? What might it mean for the future, for clients' withdrawals if you're retired, things like that. So let's start with the big question. What do we think about what's going on right now? Clearly, the stock market is extremely concerned about what a shutdown of businesses and schools and universities and social distancing, not going out to restaurants, shopping in malls. Clearly the economy is going to slow down as a result of that. The stock market is trying to predict how long this might last, how bad it might be, how many people might lose their jobs. And on the other side of the fence, the government's trying to figure out exactly how it can limit the damage to the economy when they have to make really tough decisions about trying to contain the virus that's spreading across the world. So that's why you see this yo-yo effect out there in the stock market as people are panic selling and some people are buying to take advantage of the prices. Stocks are down more than 30% at this point as of this recording. So clearly the stock market is predicting a recession. That's already priced into the stock market. The question is, how long might that last? And that's anyone's guess. Any prediction that you hear out there is just that. It's a prediction. We don't know, you don't know, no one else knows. What we do know is that the portfolios we build for our clients are built to withstand and deal with moments like this. No matter what the headline risk is that's caused stock markets to decline 30% or more, whether that's a housing bubble in 2008, a tech bubble in 1999, a global pandemic that shuts down the economy for a little while, or even back in the 80s or 70s, stagflation, or any different scenario. It doesn't matter what the headline risk is. The key is we need to have a plan for how we're going to deal with a stock market decline when we need this money to live off of when we're retired. And so the answer is a little different depending on which stage of your life you're at, whether you're actually retired yet or you're still saving. But the key is the portfolios are built and the plan has been created for how do we deal with this if this is the hand we get dealt. So at this point, I would remind our clients that each of your advisors, whether it's me or one of the other firm's advisors, has gone through the process of creating these retirement projections which have projected and built in scenarios where something like this happens and have built a portfolio that's should be able to withstand this type of shock to the system. And I'm going to get into it in a moment about the details of exactly how we deal with that. So the next question that I'll answer that we've been hearing is, why shouldn't someone move out of stocks and all the cash? And there's one very obvious answer to that is, number one, you cannot predict when the recovery will start. They don't ring a bell at the bottom and says, this is it, everybody get back in. It doesn't happen that way. There will be a lot of people, your neighbors, your friends, people on TV, people on the radio, that will make predictions about whether the bottom is here yet or not, or there's further declines to come. The ones who get it right will be lucky. The ones who get it wrong will be the same for the rest of us. They don't know. Things are unfolding quickly, and we don't know exactly when the economy will start to turn around or when we'll start to contain this. And I think the key would be that we don't have to predict that to have a successful investment experience, because some portion of our money, of our clients' accounts, is in bonds. And that's the cushion we lean on while we wait for this recovery to take place, whether the recovery starts tomorrow, next week, next month, or next year. The portion of the money we have in bonds is there specifically to lean on if we need to take withdrawals from the account while stocks are down 30% or more. So the problem of going all to cash is, number one, you probably have a big tax liability that might be due when you do that, depending on what type of account you're selling in. And number two, now you've gone from one hard decision, which is should I get out, to a second hard decision, which is when should I get back in. And in my 14-year career, I've yet to see someone get that correct, full circle. the stress and anxiety of what's going on financially does not get any easier. And the second piece I would add is people tend to, that do sell all their stocks, they get stuck in this vicious circle where even if they're right temporarily and stocks continue to go down, inevitably at some point the stock market recovery happens. Every single stock crash in history has recovered at some point. Some recover quickly, some take longer, but everyone has recovered. And so once that recovery starts, the difficulty if you've gone to all cash is now initially the first run up you've probably missed because you were in cash. And when that run up happens, the first thought that usually happens is this is a head fake. The stocks will go right back down here soon. I don't think this is a real recovery. Inevitably then the next step is the recovery continues, and now you end up thinking, uh-oh, I've missed some of this recovery. Okay, I'll wait until it comes back down a little bit, then I'll get in. As the recovery continues above and beyond that, now you're really in a negative feeling where you know you've hurt yourself. I have sold low, and now I need to buy high just to get back in. And that, of course, is the exact opposite of what someone should be doing. All of that could be avoided if people simply just stuck with the plan that's been created to deal with this, as opposed to trying to time the market and get out to avoid further declines and then get back in. In fact, if someone sold while stocks were low and they continued to go down, I can tell you they don't get more excited about buying back into stocks. They feel validated. I was right. So that timing the bottom never ends up working. It's extremely difficult to do. You have to get it right twice. You have to get out at the right time and in the right time, which no one has consistently been able to do throughout the history of the stock market. So we think that's a terrible idea. We think it's not a strategy. It's a strategy that involves difficult decisions and a lot of luck, and luck is not an investment strategy. So we're going to stick with a more disciplined process and know that we have already built the portfolios to withstand any cash flow needs that any clients have while stocks are down. So that's always a big one is, should I get out? It's the most common investment mistake that we see with people that handle portfolios themselves in moments like this. So the next natural question will be, what is Level doing with my portfolio to deal with this type of situation, even though this is a unique one given the headline risk of why stocks are going down and what's happening to us globally. The way to deal with it is not unique. It's the same way we dealt with the decline in fall of 2018, the same way we dealt with the decline of the 2008-2009 crash, or the decline that hit January 2016, or the tech bubble of the early 2000s. Usually the beginning part is simply as a reminder for those taking withdrawals and living off their portfolios, which is the vast majority of our clients. We have all the cash that comes from dividends and interest stay in cash. We don't have those reinvested automatically. And we have that for every account go to cash, so we can use that for any withdrawals that anyone has that's living off their portfolio. So that's number one, and that's still coming. The interest from your bonds is still coming in every month. The interest or dividends from your stock funds are still coming in every quarter. Now, yes, maybe some companies will be forced to reduce their dividends, but so far, those are still coming in. Second, if we need more cash flow above and beyond that, then we will be trimming some of the positions from the bond side of the portfolio. I don't even need to look. I can tell that virtually every portfolio we have right now is underweight in stocks relative to where the targets are, just simply because stock values have gone down that much in the last month. So I know that that must mean bonds are overweight within just about everybody's portfolio. And most of our client portfolios have anywhere between 25% in bonds to 75% in bonds. And so if we're overweight in bonds and we need to raise cash, then what am I going to do? We're going to trim from the bond holdings to create that cash flow. And for most clients, based on, especially if they're retired and living off the portfolio, they should have years worth of money in bonds, years worth of monthly withdrawals, quarterly withdrawals, yearly withdrawals in bonds. And so that should give people comfort that I have time to allow this stock market to recover. I'm not forced to sell stocks while they're down. We're not forced to accept these prices that are 30% lower than last month. We don't have to do that. We can wait this out. We can live off the bond side of the portfolio while we wait for the recovery to take hold. So those are the two major things that we're doing. The bond funds, just as a recap, depending on which ones we look at, for the vast majority of which have held their values, some of which are even up anywhere from 0.25% to 1.5% for the year. So when we think about stocks being down 30%, knowing that bonds have mostly held their value and done their job is exactly what they're supposed to do, and it should give people, again, comfort that we can lean on that side of the portfolio while we wait for stocks to recover. The other two things that we'll be doing, if someone has a non-retirement account and any of their investments have material losses, we may do a swap where we sell an investment that has a loss, so we can write off that loss on our taxes and immediately replace that investment with another one that's just like it. So if the stock market recovers, we still participate in that recovery, but in the meantime, the silver lining is we get to write off that loss, and that saves us money in taxes. And we've seen some that have been saving a substantial amount in taxes by taking these tax losses. So again, that only applies to people that have non-retirement investment accounts, which is not everybody. But if people have those losses, we're combing our way through all of them and taking those losses so we can write off those losses against taxes. The last thing that we'll be doing for portfolios that get really far out of balance, we'll be following what our investment policies say, which is rebalance the portfolio. Normally, because stocks generally go up more than bonds over the long run, normally that means trimming some of our profits from stocks and using the proceeds to buy bonds to get our portfolio back in line with our target mix. So I'll give you an example. Let's say you had a 60% stock, 40% bond target, and the stock market has a great year like 2019. And now at the end of the year, because stocks have gone up so much, you have 65% in stocks and only 35% in bonds. Then we would trim some of those gains from the stock market and use the proceeds to buy bonds to get you back to 60-40 and get it back in line with where the target is. Today, in this most recent couple of weeks, it's been one of the rare times where we're actually dramatically underweight in stocks relative to what our targets are for each individual client. And so what that means is a 60-40 portfolio, like my previous example today, might have 52% in stocks, and it's supposed to have 60. Now initially, as stocks go down, it feels very uncomfortable to say, I'm going to sell some of my bonds that have been holding their value and buy stocks which have been dropping dramatically. That's a really uncomfortable feeling in moments like this, but the research is crystal clear. The evidence is crystal clear that if you're a long-term investor, taking advantage of these stock market declines is a prudent and smart investment move for us to do, especially if we have enough money in bonds to last us for years and years for any withdrawals that clients need while they're living off their portfolio. So I want to walk through all of that to just let everybody know exactly what is Level and the investment committee doing during moments like this. And those are the main things that we're tackling to ensure that all of our clients' financial plans still work, all of our retirees can continue to get the cash flow that they need without hurting themselves, knowing that stocks are down about 30% over the last month. Lastly, I want to talk real quick just about a couple of things to ensure that everybody knows that we are being as safe as we can here in the office. In our physical office, usually we have anywhere at any given day 10 to 12 people actually physically in the office. Today and over the last week and going forward until necessary, we actually only have 2 or 3 people in the physical office. Everybody else is working remotely from home. Now the good news is we can do that securely thanks to all the work that our Chief Operating Officer Mike Hebron has done along with our IT service company. We can work remotely in a secure fashion, and we can do everything that we can do in the office outside of the office. So there is no loss of communication, there's no loss of capability. It's not as if someone is not paying attention to your portfolio or can't answer an email or a phone call. We can literally do everything. In fact, many of you probably have not noticed any difference despite us been doing this the whole week. So that's good news that we can fully operate without technically being in the office at all. So I just wanted to give that update just in case anybody had some questions about what exactly is Level doing, knowing that the state and the country is moving towards a little more isolation, people working from home, so we can kind of stop the spread of what's going on. So I wanted to walk through all those things. We want to shoot this video and share it with everybody just so we can answer some of the most common questions that we've been hearing. If you have a question, feel free to email your advisor or call your advisor. We're here to help. And certainly if you're feeling like you just want to talk this through, like you are feeling anxious, like you're feeling overwhelmed, which everyone right now is, give us a call. This is our job, is to walk you through these terrifying moments in the stock market, but also to let you know that we built the portfolios to withstand this, to be able to last through several years and then some stock market declines without interrupting your lifestyle really in any way from a financial perspective. That's the job you've hired us to do, and we want to be here to give you that comfort, that perspective on how are we dealing with this, what's the plan. There is a plan for everybody, and we are implementing it through the things we've been doing with our clients. So again, give us a call if you're feeling some of that anxious feeling, that uncertainty. We are happy to talk it through with everybody, and we will continue handling the investments, monitoring the financial situation, answering your questions, even if they're non-portfolio related. Tax season is still happening, believe it or not. So honestly, give us a call if you feel the need to talk or if you want to walk through this. We are happy to help. Okay, thanks everybody. We'll talk to you soon.